go across. We have Prateek Agrawal, Managing Director and Chief Executive Officer at Motilal Oswal Asset Management Company, joining us this morning. Prateek, great having you. Uh, it's not been an earnings season which we can complain about, Prateek, but
Yeah.
are more of the negatives really getting penciled in into FY27, and is that why we're seeing the negativity on the street?
So I think if you look at numbers, mostly numbers will come in as per expectations. Till the government and some of the PSUs take the shock, absorb the shock, it is not being transmitted to India Inc. I think till then the numbers will be as per expectation. It's like business as usual. The oil price increase has been transmitted only to a very small extent. So it's not about numbers. It is about the fact that we as an economy don't look good just now. People understand it is stressed. So if you are stressed, then what do you sell? How do you manifest your thought into action? It is by selling what you have. So banks which are pretty heavy in FPI ownership basket are seeing selling for that count is what my sense is. IT, of course, is an AI trade. So there it is sometimes positive, sometimes negative, but more to do with every new launch of a capability in AI. So that is the problem on the index. These two sectors put together make up close to 50% of the large cap index. And if these don't perform, index will not perform. Life is outside of index. So where all of these, less owned by foreigners spaces are there, where growth is continuing pretty strong. So you spoke of this quarter season, this quarter, last quarter, the quarter before, 4 quarters, you have seen the breadth of the market being better than the narrow market in terms of quantum of earnings increase. So I think markets are also reflecting that.
Pratik, if the life is outside the major caps, then which are the ones which you're looking at, mid cap and small caps, and which sectors or stocks which are active there for you?
No, so we are not cap focused. Let me start by saying that we are growth focused as a house. Now, look at spaces like EV. There is nothing which is there in the large cap space or mid cap space, two pure EV companies, both small cap space. If you look at digital, there is one company which is large cap, others are mid or small. In the same manner, if you look at capital marketplace, the AMCs may be large cap, everything else is mid or small. So flesh out spaces where there is growth. In pharmaceuticals, we are with the semaglutide story. Now, most of the names there are mid or small. So even the most nicely placed names, if they happen to be in mid or small, we are fine. It's not about caps. It's not about caps. Ultimately, if there is something which is, large and it's fallen into mid, and mid which has fallen into small is clearly a no-go space for us, right? You want something which is moving up the cap tables. So which we believe is enabled by strong, sustained multi-year earnings growth. A lot of that is now outside of the index. So think of any new multi-year growth theme that you have. Take defense, too large cap, everything else mid or small. And you can position accordingly.
Prateek, in terms of IT in particular, risk reward turning favorable, and if not, at what point does it turn favorable?
So IT, the lens with which Indians see is different from the lens with which foreigners see. Okay, foreigners would compete an Indian IT company with an, let's say, name abroad, Accenture, Cognizant, etc., that they can invest into abroad. And now those names, some of them larger than the largest Indian IT companies and growing as strong, if not stronger, with similar quality matrices are available cheaper. Okay, our lenses are different. Foreigners will look at dollars earnings and dollar earnings growth. We in India will look at rupee earnings growth. Now, to Indian eyes, I think Indian IT services after the crack offers value. While I say this, in most of our constructs, IT is zero or less because, like I said, we are growth investors and this is not where growth is. So what we may have in the house is mid IT or small IT where there is growth, not in large IT, but it is cheap across the board. So for value investors, this is clearly a space to look at. So for Indians, Indian IT, especially with the rupee depreciation, is a great story over financial 27. Now in IT segment, large, mid, and small. Here there is again a period of very strong disruption. When disruption happens, the larger a business is, the more pained it is. Okay, simply speaking. So if you are in the mid cap space, the disruption is an opportunity for you to gain market share. Actually, if you are in a smaller cap space, it may offer you even better opportunity. So I think that is the way to address the IT services space just now.
Pratik, having seen the earnings season very closely, Q4 earnings season, which are the sectors or segments where you see that, despite the geopolitical risk, macro challenges, there are some sectors which will grow at healthy double digits from here?
So every issue of the kind that we are experiencing clears the mind, and when it does so, policy making gets focused in those spaces. So if the issue is oil price increase and it is unsustainable, it's like we are bleeding 7 billion a month. How do we get over it? So the next time it happens, we are better prepared. It is by increasing electricity generation through domestic sources. Now, so, expect more focus on coal. It sounds strange, but coal is what we have. We need electricity. This is a country of 145 crores of us. The cheapest form of electricity. We will use it if oil is so expensive. Point one. It could be coal gasification. It could be, compressed biogas. Yes, it will be solar, wind, and BESS, right? It would be move away from ICE into EVs. Okay, already we have achieved close to 100% electrification in railways. More such spaces could come up. So electrification. Now, when this is happening, clearly it means that unlike in the past, when electricity demand used to move in line with economic growth plus minus 0.5%, expect that percentage delta to be more and on the higher side as we go forward. Now, when you are again pressed with this kind of a scenario, the other thing that you are looking for is, importing less, trying to export more. So importing less, how do we do it? By incentivizing domestic industry for import substitution. So see more of those initiatives happening. So, cheaper land, PLIs, revenue based incentives. So all of that kind should be expected to continue to replace substitute imports. You're looking at the world and the nature of warfare has changed materially. There is one kind of war being fought between Russia and Ukraine. I would say that's more traditional. There is another kind which happened between the West and Iran, where what you saw was completely different dimension. Now, every country, to its ability, will end up trying to be in a better position versus what you have seen. So this again becomes a multi-year growth theme, not only in India but globally. And of course, with it, stuff that doesn't get impacted by oil price and all, which is digitalization, continues. Move away from savings to capital market continues. So, these are clear themes where impact of war is not there. In fact, since policy focus may be more here, in some manner, they could be winners of the situation that we are in.
Pratik, if that is the case, give us a sense of some of the traditional sectors that funds or investors have been flocking to in the last 2 to 3 years, which is financials. You yourself mentioned that between financials and IT, it is a bulk of the index weight. How do you look at balancing this entire scenario where, and which are the sectors which you think will be the next emerging sectors having higher weights for the index?
No, index will take a lot of time to change its complexion. In the interim, it will be, change in weights because a lot of the emerging themes that we spoke about will take time to get into the index. They're still in the, small and mid cap territory. So it will take a year or two before the index changes complexion materially. Now, if banks are in the index, well, if you have a construct where you want to hug the index, yes, you need to have banks. But earlier, people had, think of it, people had private sector banks. Why did people have private sector banks? Because those banks were growing way faster than the economy and banking in general and incurring less NPAs, right? Now it is all the same. They have all grown large. They are growing in line with the economy and in line with PSU and incurring something similar in terms of NPAs. So where is the choice? And today they are priced at least 2x more expensive than PSUs. So I think while they may have declined materially the private sector bit versus where they used to trade before, but the convergence in delta of what they were performing versus the PSUs is evaporating very rapidly, which means the valuations should also converge much more going forward. So if you look at our constructs, for a long while, many of our constructs have been running with zero banks. With zero banks. We may have some fast-growing NBFCs, but otherwise, many of our constructs are actually zero banks, zero large cap IT, zero consumers as well.
Okay, Prateek, thank you so much for coming in and giving us this perspective. Of course, just at the fag end of earnings season and much necessary, this conversation. Thanks for that.